How do you spot red flags in balance sheet analysis? Imagine trying to buy a house without inspecting the foundation. You might see a beautiful exterior but miss serious structural issues. The same idea applies when analyzing a company's balance sheet. It's a quick snapshot of what the company owns and owes at a specific moment. But hidden problems can lurk beneath the surface. For traders and investors, spotting these red flags can save you from big surprises down the line. First, watch for sudden or large changes in key accounts. If assets like cash, inventory, or receivables jump or drop sharply without clear reasons, it could signal trouble. For example, a big spike in accounts receivable might mean the company is struggling to collect payments, which could hurt cash flow. Likewise, a sudden increase in inventory might suggest overstocking or poor sales. Next, check the company's debt levels compared to its equity. If the debt-to-equity ratio is very high, it means the company relies heavily on borrowed money. This increases financial risk, especially if interest rates rise or sales decline. High debt can lead to volatile stock prices and even default if the company cannot meet its obligations. Look for off-balance sheet items. Some companies hide liabilities outside the main balance sheet through special arrangements. If footnotes or disclosures reveal large off-balance sheet obligations, it can hide true financial risks. These hidden liabilities might affect the company's ability to pay debts or fund operations. Another warning sign is negative or decreasing working capital. Working capital is current assets minus current liabilities. If it turns negative or keeps shrinking, the company may struggle to pay bills on time. This could lead to liquidity issues and potential insolvency. Aggressive accounting practices also raise red flags. Watch for signs like high goodwill or intangible assets that seem inflated compared to tangible assets. If a company makes many acquisitions and records large goodwill, it might be overestimating its worth. This can distort true financial health and mislead investors. Related party transactions are another concern. If the company does business with subsidiaries or affiliates at non-market prices, it can manipulate earnings or hide liabilities. These transactions can make the company look healthier than it really is. Check the shareholders' equity. If it is negative, liabilities exceed assets, which is a serious warning sign of potential insolvency. Even very low or declining equity can indicate financial weakness and increased risk. Assess asset quality. Assets that are hard to value or convert into cash, like obsolete inventory or non-performing loans, weaken the balance sheet. Traders should consider how easily assets can be sold or turned into cash if needed. Finally, pay attention to any recent restatements or warnings from auditors. If a company has to revise its financials or receives qualified opinions, it suggests issues with accuracy or reliability. For traders, these red flags help avoid stocks that might suddenly drop in value due to financial instability. For options traders, understanding balance sheet risks can guide strategies like buying puts to protect against downside moves. Spotting companies with strong, clean balance sheets can lead to more stable investments with less price fluctuation. In the end, examining the balance sheet carefully and paying attention to these warning signs can help you make smarter trading decisions. It's all about understanding the true financial picture and avoiding surprises that could impact your investments.